Welcome to Market Overtime on the Schwab Network. I'm Oliver Renick. I'm here at the CBOE floor in Chicago as we continue to talk ETFs in the Bitcoin world post-spot approval and launch more than 2 months ago. The Ark partner and advisor to the fund, Ophelia Snyder's 21shares, in the banner behind us here. A bit of a celebration, a couple months still going, Ophelia.
Yeah, we're about 2 months into it, and we're really excited.
So how have you responded to the flows? This is like crushed every ETF standard, basically, and you handle a lot of kind of the mechanics.
Yes, so our job within the partnership with Ark is really, we run the ops, we run the movements in and out of these funds. We've been doing this for about north of 5 years now, because we've obviously been running product that long in the European market, and it's been really exciting to see, I think.
You're Switzerland-based.
Yes.
And
yes.
You've had other funds, the ETPs, prior to this.
Yeah, so we run about 40 funds offshore that hold spot crypto. That's essentially all we do. We are a very dedicated firm. We do crypto products. We do spot crypto outside of the U.S. We have a couple of futures products in the U.S., but that's an anomaly for us. Pretty much everything we offer globally is spot.
Does the great success of Ark and other spot ETFs cannibalize any of the other funds? Are those going to stick around?
We haven't seen too much of that yet. Realize there's obviously some segmentation between the markets. It's difficult, for example, for Swiss retail to trade U.S. products. It's one of the reasons why you do see multiple products like the S&P 500 that would come up in a version that's distributed in a UCITS fund versus a version that might be distributed in a 40 Act product in the US. So I don't think you're going to see a complete consolidation, but we have seen institutional flows shifting. We're seeing more international demand than I would have expected for US products, and we're still seeing extremely robust demand in Europe, sort of from the EMEA region pouring into European exchanges. And I don't think that's likely to change anytime soon. They are fundamentally quite different. There's also a markets hours component to this.
When you talk about institutional flows, it's hard to kind of measure those things. Can you do that? Do you know who's been behind it? Are there those folks who were representing a bunch of clients or ran a hedge fund or whatever that now are interested with the ETF?
So in order to know anything about what's going on in an ETF, you've either got like the capital markets tea leaf reading where you're looking at the order book and you're trying to understand what's going on, or the clients have to tell you. Unfortunately, we don't get much more information than that. But from what we can see, from the clients we're in touch with, from what we can see from these order books, you are seeing the early innings of institutional advisors coming into the space. Extremely early innings of that. Primarily what you've seen so far is self-directed, which is crazy given the numbers that are coming out here. You're seeing some prop from institutions, and you're seeing primarily self-directed. The real advised capital in the United States is still coming. Typically takes at least 90 days, right?
Okay.
We haven't even cleared that yet.
ARKB's got about little less than $3 billion in assets. The flows into all the spot ETFs, about $10 billion net right now. The market cap of Bitcoin itself has expanded $500 billion. How do we make that math make sense?
It's actually quite simple. This is a supply and demand driven market, right? At a fundamental level. It trades like a commodity, like gold. So what's happening is you are seeing a massive surge in demand from a new cohort of fresh capital. I'm also of the opinion that actually you're seeing more fresh capital come in than even those numbers would suggest, because I'm not sure that actually the money that is coming out of some of the legacy product is actually coming back in. It seems to be a very different cohort of clients. So what I think you're seeing is a wave of demand as people honestly just begin dipping their toes. Most of what you're saying is, I'll give a little bit. 10 basis points, 25 basis points, let's try it. We're going to see people build to a few percent allocations, and if you look at research around portfolio allocation and construction in this space, it's extremely well supported to get to those levels in terms of, on a risk-adjusted basis, enhancing returns. We haven't gotten there yet. You're still at the dip your toes stage. The issue is that the market was not pricing in the realities of what demand looks like once you start catering to that much of a larger audience, and that audience controlling so much capital.
Are they also dipping their toes in Dog with Hat and PayPay Coin? Because the altcoins are up the same amount in market cap, $500 billion. Bitcoin's dominance has only changed 1%.
So you do see some correlation between assets in this space. I think the meme coins has always been part of the cycle. I mean, you've seen that with Doge, you've seen that with other names, but there are also quite a lot of like real projects and alts, things like Solana, things like, you know, even Ethereum to some extent, which is not yet available in the US, right? The dynamics around the ETF are not impacting these names yet, but you are seeing some exuberance there also, and I think a lot of that is coming from the pullback of the overhang from the bankruptcy estates. We've sort of come out of FTX, come out of the Genesis bankruptcies. You're starting to see these estates resolve themselves. As that happens, and as you move away from these black swan events, that overhang on the alts is coming off.
So people start dabbling again.
Exactly.
If you've got the same market cap change in Bitcoin and the alts since the ETFs, what conclusion can we make about ETFs spurring new buyers? If this is, in fact, it's actually the spread between them is about 13 billion. So this other $500 billion, what's happening here?
So I think what you're seeing is a couple of things. I think you're seeing, like I said, a change in market sentiment. That is a real thing. I think you are seeing some crypto native crowds that are now taking profit in Bitcoin and reinvesting them in other names, and that is something you see, but that's unrelated to the ETFs.
Okay.
It's a different pool of capital and a different client base. I think the other thing that you are seeing is renewed interest in blockchain applications. You're seeing renewed interest and more development and partnerships with large corporates, with governments, with real projects, with real use cases in this long tail. And quite frankly, you are still seeing quite a bit of institutional demand. We primarily see that offshore because obviously these products don't exist here. But for example, our Solana product offshore has massively outperformed this year, both in terms of actual asset appreciation as well as flows.
Yeah, Bitcoin's only like number 30 in terms of returns on the year.
Exactly.
Does that complicate the success going forward of the ETFs if you're a buyer who's trying this out for its diversification or its store of value and it's trading like Bitcoin?
So no, because I think the issue is not so much when you get into some exuberance around meme coins. I think that's not a stable area of the market, and that's understood. I think
those are overvalued then right now.
In my view, yes.
Okay.
I think what you do see is with Bitcoin, you're seeing fundamentals shifts, and I don't think it's for the same audience. In the same way, by the way, you can have penny stocks in traditional finance that are absolutely not being sold to pension funds. They're being sold to primarily people who are looking for a very high risk exposure.
Okay.
And so I think you will see people continue to dabble in that. I think you will continue to see some aggressive trading in that space, but I would expect that pricing to be far less stable and robust, and the price discovery around those things to be far choppier than something like Bitcoin, where we are really going through a true price discovery moment around what does the global community actually value this asset as.
How are we going to measure that true price discovery or something specific to Bitcoin if it's still trading correlated to the alts? Do we need to see it have a moment where it like rallies beyond while they crash? Should we be expecting a big separation within the crypto world post ETFs?
I think you will likely see some separation in the behavior of these assets, because one of the things that's happening in Bitcoin is you're not only growing the holder base, you're diversifying it, which means a young person who's just learning to invest for the first time versus somebody who's looking towards retirement are going to have very different perspectives on risk and on market cycles. Once you start diversifying that base and having a much broader cohort that are invested in and excited about the sector, that's when you're going to start to see some price stability.
Okay.
So you can't have a product run up 200% without volatility. It's sort of the way we measure volatility would be captured in that. I think what you're going to start to see is once we've completed this price discovery moment, you're going to start to see that volatility taper off in a really real way, whereas I don't think that's going to be true in almost any of these other names because they're not experiencing that same expansion in the holder base.
It sounds like it will be a really good test then to see who's in this, because I would think that some more traditional investors may not be able to hold on for the ride the way some of the kind of maniacal hodlers or meme traders do when they ride things down 60, 70%. People would say, I'm never going to sell a traditional RIA. Might go, you know what? I tried that hot sauce in my fund and it just did worse than the NASDAQ. I'm out. But I guess we'll find out.
We'll find out, and I think maybe interestingly is if you look at the data, it is not about timing in Bitcoin markets. It's about time. Typically, long-term holders in this sector on most time horizons in excess of a couple of years are very well rewarded for doing so. So the question is going to be clients coming into this space who are working with their advisors or institutional managers, you're adding some hot sauce here, yes. Are you comfortable with what that's actually going to do? It's one of the reasons why we've actually brought in the suite to include other products like ones that trade between Bitcoin and cash to help tampen some of that volatility for people. It's a very, very different investor profile. You do, if you're coming into these products, you do need your clients to be comfortable with, products that are 70, 80 vol.
Well,
that is a real
as
thing.
we read earlier, the prospectus of Ark B includes a line that says volatility risks include price action that could go to zero. That's in the prospectus, which I haven't seen anywhere else. It's certainly not in GLD.
I think that's just prospectuses are a reflection of what regulators would like issuers to write, not necessarily.
So that's Gary Gensler's line in there.
I think, every investment you go into can go to zero.
Yeah.
And I think that's a very well-known thing. And if you read disclaimers for most funds, there's a section in here that says volatility is a real thing. You could lose all of your assets. You will not lose in excess of your principal. I mean, that's a pretty standard disclosure.
I control F'd a few, and GLD doesn't have a zero in there, as you guys like to compare it to gold, but I obviously haven't read every prospectus in the market. Let's talk about the price expectations that people get in. As you talk about time in Bitcoin, a lot of that revolves around this idea that halving is a price catalyst. What are the standards that you have set? What do you want to see? What would constitute surprise or disappointment over the next year?
So I've been in Bitcoin long enough to know I'm not surprised by much. I will say halvings are interesting. There's always a narrative around them that, they are priced in. It is an absolute known thing. There's no price discovery associated with that because everybody knows it's coming on a specific day, down to the minute, and everybody knows what's going to happen. That transparency is great from a monetary policy perspective because it means you actually know what's going on with your asset base. But I will say, historically, that hasn't been true. Because the issue is, you can say that as much as you want, but you are creating a gap in the order book, right? There's pretty healthy selling into this market from miners who need to fund operations.
Right.
And they're continuously sell pressure in the book. If you have that sell pressure, it does change the order book construction.
Assuming the demand doesn't change.
Assuming demand doesn't change, it's going to change the order book construction.
What would be a disappointing halving? Because in the past it's been like thousands of percents, but it always kind of gets a little bit smaller. So what should be our bar for success for this for the next year?
So the issue is it's extremely difficult to say right now because of what I said at the beginning around we're in this strange phase where the audience is both completely different and massively larger and includes a far more robust set of microsegments. Ultimately, long-term good for Bitcoin makes it incredibly difficult to predict the market right now because I don't know how a 70-year-old who's looking at retirement is thinking about Bitcoin in their portfolio.
Right, yeah. To a point earlier, I agree.
Exactly. So we have a lot of pent-up demand. That has not in any way abated. You can see it in the ETF flows, but quite frankly, anecdotally, you can see it in the fact that we are still not in a position where you're getting solicited flows of any kind. This is all unsolicited still. There are a couple of small platforms that have allowed for solicitation of these products and a couple of small models, but it's peanuts compared to what we know this industry actually looks like. So I think one of the bigger question is less the halving and more the timeline of how this is progressing and sort of the allowance on platforms that's progressing and how those two things are going to intersect in time. Because, for example, if you come onto all of these platforms and you increase that demand portion significantly ahead of a halving, it's going to be more difficult for the halving to create outperformance.
Okay.
However, if there's an element of time compression here because you're basically tweaking both the supply and the demand side. You're tightening supply and you're increasing demand essentially at the same time. So it
sounds like a pretty good combo.
It's a great combination from a fundamentals perspective, but it does make it on a short-term time horizon incredibly difficult to predict.
Here's one thing I do know is that more than ever, traditional finance-oriented people outside of the crypto world, ETF or not, are talking about the halving in a way of expectations for price action. What if it doesn't work? This reliable thing that everybody has always seen go up thousands of percent. Do we trust the crypto community to not dump on our heads after we just bought the ETF?
Yes, mostly because I will say the last halving, the halving came, everybody was so disappointed. And then you fast forward 6 months and it looks different. So I think, and by the way, very similarly,
give it a year, right?
But think about the ETF. Everyone was so excited. It's going to be a sell the event moment. It's going to result in Bitcoin coming off. Yeah, it did. It came off for a week. And then the ETF flows changed the market structure. And so this is one of the things that I think people are very micro-focused with this. And the crypto community can sometimes do that. But I will tell you, everyone was incredibly disappointed by the last halving until now you look in retrospect and they're like, no, that was good.
High
but the
bar,
people
I guess.
who'd seen the one before were like, well, this is nothing. That's
Right.
not great. I mean, there's a little bit of hindsight and rose-colored glasses to some of this stuff. I do think we need to get to a place where that order book starts to stabilize, which means we need to actually understand what real demand looks like once you get through the pent up and you actually have solicited flow and you really do know what this looks like. And then you need to get through the halving to actually understand the supply side in a real way.
All right.
Once we get beyond that, I think we'll be in a stage where you can say that price discovery of these two changes in the order book have been priced in, and then we can start to look at what is that long-term view on Bitcoin and Bitcoin price action. I think you will see some chop as we figure that out.
Seems like post ETF, more pressure than ever on halving here as everybody's eyes are on it. Ophelia, thanks so much for your time.
Thank you for having me.
Absolutely. Ophelia Snyder, CEO at 21shares.
Thanks for joining us on Market Overtime. Don't forget to download the Schwab Network app on the Apple App Store and tune in 24/7 at schwabnetwork.com.